Before every major market crash, the same exact three trades show up. Not after the headlines, not during the panic, but well before. The exact same thing happened in 1929, 1987, 2008, and 2020. Different catalysts sparked the bear market each time, but the same positioning took place by the smartest investors in the room. And here's the part that matters. Those three trades are quietly happening again right now. In the next few minutes, I'll show you exactly what they are, why they map perfectly to how crashes unfold, and how you can position yourself before the crowd realizes what's coming. Before we dive in, let me introduce myself. I'm Steve Reitmeister, but everyone calls me Righty. I was formerly the editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com, where our quant team analyzes thousands of data points to help investors beat the market. If you want more videos showing you how to potentially profit during market volatility, then go ahead and hit that like button. That lets me know I should make more videos like this in the future. Most people think crashes are random. They are not. People imagine that some negative headlines hit, like a bank fails or severe problems in the employment report. The next thing you know, the market starts to collapse. But that's not how it works. Crashes follow mechanical, predictable sequence that alerts you ahead of time. Knowing this in advance allows you to sidestep the carnage or eventually profit from it. Now, let's review the 5 telltale signs of looming market disaster. Valuations detach from reality. People start paying any price for the hope of what comes in the future. Yet, as we all know, hope is not a real investing strategy. Leverage saturates the system. Margin debt rises. Cheap borrowing becomes normal. Risk gets disguised as confidence. This is the part that everyone focuses on, but they're completely missing the other signals. Number 3, a trigger event shows up. Could be anything like a slew of bellwether earnings misses, a bank failure, geopolitical shock, or a recession print. This is the part that everyone focuses on, but they're completely missing the other signals. A trigger event by itself is not enough to cause the market to collapse. It's really just the market's excuse to start the deleveraging process. Number 4, forced selling begins. Margin calls, liquidations, funds deleverage. This is where the machine takes over. You need to be positioned before it gets to this stage. Number 5, panic spreads. Prices falling becomes the reason for prices to fall even more, right? FOMO, liquidity disappears, just a guessing game on when and where we find bottom. Now, if we strip away the stories and the emotions, it's not mysterious. It's a leverage system going from stable to unstable to forced liquidation. And because the sequence is mechanical and predictable, the sophisticated investors know exactly how to respond. The good news is that you can do the exact same thing, regardless of your account size or experience level. So be sure to stay tuned till the end of this video, as I'm going to share with you the 3 exact trades the smart money and billionaires make each time this doom cycle begins. Let's quickly review all 3 trades, then we'll take a step back to appreciate them all in depth. Trade number 1, convert risk into cash. That's a classic get out before the stampede type of move. Trade number 2, protect your purchasing power. Because after crashes, central banks often respond with stimulus, liquidity programs, and money print that can spark inflation, which erodes away at the value of cash positions. Trade number 3, buy crash insurance. These are a set of trades that actually rise when the market falls, like put options, credit protection, and short selling. And then there's an unofficial 4th trade after the crash, where you buy near the bottom at fire sale prices. But you can't do that 4th trade if you didn't survive by employing the first 3 trades. So let's get more in depth with each one of these one by one. All right, trade number 1 is the earliest signal when the smart money starts going to cash when everything else still seems quite bullish. This is a move worth watching. It typically happens 12 to 18 months before the crash, not because investors have a calendar, but because that's when the odds for greater upside stops making sense. At late cycle extremes, the upside becomes limited because of heightened valuations, and the downside becomes a bit more catastrophic. Plain and simple, the richest investors don't stay fully exposed when the risk-reward flips negative. This causes them to reduce risk by first raising cash. Very few people are going to all cash. Simply, they want to lower their stock-heavy exposure as the risk-reward becomes less favorable. Now, at this late stage of a bull market, people might mock you for such a heavy cash position. That's because optimism still runs too high, way too high, right? That's where you hear the chants, cash is trash, but that totally misses the point. Cash is not an investment. Cash is a survival tool. And more importantly, cash is dry powder to snap up stocks at deep discounts when we start reaching bottom. Because here's the real secret. Some of the biggest money is not made during the bubble, it's made after the bubble bursts, when great assets go on sale. But to buy the sale, you need to have cash when everyone else is stuck. That's why this trade shows up before every major market crash. In 1929, Joseph Kennedy was a ruthless speculator of the roaring 20s. He understood how euphoria worked, and he understood the dark side of leverage as well. When everyone is fully invested and over leveraged, you eventually hit a ceiling. There are simply no buyers left. And when prices dip, that excess leverage turns into forced selling. So Kennedy started his exit in advance, methodically, not all at once, but steadily. He raised cash before the collapse accelerated. Same thing with Paul Tudor Jones in 1987. He looked at valuations, leverage, and a new destabilizing factor in program trading. This all added up to an unstable situation, pushing him to raise cash even while the market still looked quite fine. This is how he survived the biggest one-day drop in stock market history. In 2007 and early 2008, the smartest money built cash because they couldn't find attractively priced opportunities. That's the quoted phrase you'll hear again and again. I can't find anything worth buying. Translation: prices are too high, and thus the market is getting too risky. Now, here's the practical version for normal investors. This does not mean you have to sell everything and hide in a bunker. It means you stop treating being fully invested as a virtue. It means you raise your investing standards the same way the smart money does. And if you want a simple rule of thumb, the more your portfolio is filled with weak balance sheets, hype-driven multiples, and unprofitable growth, the more vulnerable you are when things head south and liquidity disappears. Because crashes don't hit every stock equally. They hit fragile businesses the hardest. And the biggest winners tend to share something boring in common. They can survive stress. They don't need perfect conditions. They have real cash flows, healthy balance sheets, and demand that doesn't evaporate overnight. That's the real point of trade number one. Reduce your exposure to fragile assets, raise cash, and increase the opportunity so you can profit in trade number four, to buy the best stocks at rock bottom prices, but more on that in a moment. Now let's talk about why cash alone isn't enough. Trade number two is about preserving wealth when policymakers respond to the weakening of economic conditions. Because what happens after crashes? Central banks cut rates, governments spend, liquidity floods the system. That is often a necessary step, but it does come with consequences. The main consequence is that cash loses purchasing power from these often inflationary measures. So sophisticated money often pairs cash with a hedge against this debasement. Traditionally, the go-to hedge is gold. But now, a quick note. Gold is not a magic investment. It's not about getting rich in gold. It's about having an asset that tends to be a solid performer in shaky times, especially when government policies create inflation or erode the value of the US dollar. Gold is insurance, and insurance is usually something you don't fully appreciate until you need it. After the stock market crash of 2008, we saw a huge policy response with quantitative easing, rate cuts, and liquidity programs. Not surprisingly, gold performed strongly in the years that followed, not because gold suddenly became productive, but because the system was being reflated. And again, this is not a pitch to go all in on gold. A modest gold allocation is fine because you're doing it for one reason: purchasing power protection. Buying gold doesn't mean that you have to load up on physical bricks and coins and store them in your garage. Truthfully, doing that is kind of a hassle. There are plenty of gold stocks out there as well. This includes miners, gold royalty companies, and other entities that can benefit from the same gold tailwinds I've been describing. For instance, I held one gold stock, Kinross Gold, with a symbol of KJC, in my Zen investor portfolio for only a year. This stock absolutely crushed it during the market uncertainty over tariffs in April 2025, allowing me to cash in on a whopping 142% gain. That's the lowdown on trade number two. Now let's get to the trade everyone finds exciting, but most people execute very poorly. And if you like this video so far, please hit subscribe and the notification bell. That way you'll be the first to know when I post more videos like this in the future. Once again, trade number three is where folks are seeking to profit from the weakened market conditions. This is the move that doesn't just protect you, it can potentially make you wealthy when panic hits and the market goes down. And it works because volatility spikes violently during crashes. One of the tried and true ways the smart money does this is through buying put options on broad market indices. If you don't know what a put option is, it's basically like insurance. You pay a premium for the right to sell at a certain price. If the market falls hard, that right becomes extremely valuable. If the crash never comes, you lose the premium you paid. Here again, just like paying for insurance. Now, this is the part where I need to be blunt. Options can blow you up if you don't understand proper pricing or sizing. Options can burn you fast unless you know exactly what you're doing. So please watch this free webinar that I put together to see how the Zen ratings change the game for how to effectively trade options. I'll put a link in the description or scan the QR code now. But I digress. This is not for beginners who want to get rich quick. This is for risk management and asymmetric payoff. If you're going to use this trade at all, it has to be small enough that you're okay with losing what you put into the trade. Just think of it as the fair cost for downside insurance. 1987, Paul Tudor Jones used puts going into 1987. When the market fell 22% in one session, that protection became extremely valuable. Let's flash forward to 2008. Famed investors from the movie The Big Short, Burry and Paulson, used credit protection. This is a different instrument than put options, but the same basic concept. In 2020, Ackman bought protection, made billions, then redeployed at the market bottom. They all bought protection before the crowd believed the risk was real. And boy, were they right. Same pattern. Buy protection when complacency is high. Profit when panic hits. Then use the capital buy at the bottom. Now, here's the key insight. Trade number 3 usually happens within 6 to 12 months of the market crash because it's expensive to hold that insurance forever. You don't want to pay premiums year after year for something that might not happen. So, sophisticated money waits until the setup is becoming obvious, where valuations are stretched, leverage too high, risk rising, and the cracks are forming. This is the time to buy that downside protection. So, how do you know these trades are happening so you can take action? Well, that's actually kind of easy. You look for the signals, this combination taking place. This part is crucial, so don't miss this. These are the 3 signals that tend to align with the 3 trades. Signal 1, big money raising cash, trimming risk. Watch for elevated cash positions, risk reduction, and can't find value language from the disciplined investors, the seasoned traders with track records of success, not just the average talking heads on TV. Signal number 2, gold demand from institutions is on the rise. Central banks and large institutions aren't buying gold because they're bored. They buy it when they're thinking about currency risk and system stability. So watch what they're doing and respond accordingly. Signal 3, rising demand for protection. Unusual hedging activity, increased appetite for downside protection, volatility pricing that suggests institutions are paying up for the downside insurance. Remember, none of these are a clear signal on their own. It doesn't say the crash is coming tomorrow. But when all 3 are in motion at the same time, it tells you something simple. Sophisticated money is not positioned for a smooth flight. They're buckled up for turbulence. Now, let's get practical here. Most people watching this don't have access to credit default swaps. You're not Michael Burry. Here's the simplified playbook that helps make sense of this for everyday investors. Take some money out of the market and put in cash. Yeah, the same trade number 1 as the pros. Again, not all in cash. You are simply lowering your exposure to any potential stock market downside. The stocks that remain in your portfolio should be the highest quality positions in more conservative industries. I'm talking about large caps in areas like healthcare, utilities, and consumer defensive. Large dividend players also hold up quite well in these conditions. The best of the best even rise as income stocks become much more attractive as the Fed lowers interest rates. Now, your best bet for finding the healthiest companies in these groups is the Zen Ratings Quant model with this 115-factor fundamental review. Here are the key elements to find stocks more likely to weather any coming storm. You want A and B rated overall. That's the top 20% of all stocks based upon their fundamentals. And A and B rated in these key areas of growth, consistency of growth, financials, rock solid balance sheets, and safety. These are the combination that will point you in the way of the stocks that will weather the storm the best. Your best choice for trade number 2 is gold. That could be a gold ETF or picking the best gold mining stocks. The Zen Ratings once again shines a light on these via our industry page for the group that ranks the stocks from best to worst. Follow the link down below or this QR code to go directly to the gold stocks industry page on WallStreetZen.com. As for the best downside protection in trade number 3, that would most certainly be inverse ETFs. This is essentially a short on the stock market that will rise in value as stocks decline. Do not get enticed by the much riskier 2x and 3x leverage varieties. Stay in the core 1x positions. We're talking about SH, which is an inverse of the S&P 500, or PSQ, an inverse or short of the NASDAQ 100, and finally, RWM, a short or an inverse ETF of the Russell 2000, the small cap index. The overall goal of all these trades is not to gamble. The goal is to survive and be ready for what comes next. That brings us around to trade number 4, to buy quality stocks at the bottom. Truly, this could be the one that generates the most wealth for you in the long haul. This is the move almost nobody does. Everyone says, hey, I'm going to buy the crash, until the crash arrives and it feels like the world is ending. So build your shopping list now of the quality businesses that you would love to own on a discount. Once the market is down 20 to 30% is when you start dollar cost averaging your way into these wish list positions. This is a moment where access to our portfolio like Buy the Dip inside our Zen strategy service can help the most. This unique portfolio scours our Zen rating system to find the most fundamentally sound stocks that have just endured sharp price corrections. This allows us to get on board some of the best growth stocks at the very best prices. Learn more about this proven track record of our Buy the Dip portfolio and all the other market-beating portfolios inside Zen strategies by following the link you see on your screen or just scan the QR code. All right. And by the way, if you want a fast forward button to some great stock picks in today's stock market, then click the link in the description or scan the QR code to get my free report, 3 stocks that doubled this year. We covered a lot of ground today. So let's get to the bottom line. The best investors don't react to crashes. They prepare while everyone else is still celebrating like the good times will never end. So what do you think? Do you think we are due for smooth sailing in 2026? Or will we be getting late in the cycle and time to prepare for rough times ahead? Please share your thoughts in the comment section below for the benefit of our community. And if you like this video, then be sure to check out my next video on why the market crash hasn't happened yet.